Today we are going to talk about the taxation of capital gains. Imagine you are selling an asset, both as the manager on behalf of a corporation, and as an individual. If the sales price exceeds the tax book value, you obtain a capital gain. Now you wonder, how it is taxed? The tax treatment of the capital gain depends on whether you sell a business asset, or a privately held asset. Due to progression and inflation, many countries allow for preferential treatment, addressing either the tax base or the tax rate. Let's first talk about the taxation of capital gains from business assets. Addressing the tax base, we distinguish between four different methods: exemption, allowance, indexation, and rollover relief. Under the exemption method, capital gains are fully or partially tax exempt. If an allowance is granted, the corresponding amount is deducted from the tax base. In the case of indexation, the acquisition costs are multiplied with an indexation coefficient, resulting in a lower capital gain. A rollover relief may be applied if the disposed asset is replaced. In this case, capital gains are exempt from taxation and deducted from the acquisition costs of the replacement asset. In other words, taxation is deferred until the new asset is sold or depreciated. For a preferential treatment using the tax rate, two methods may apply. First, capital gains can be taxed at a reduced rate. Second, taxation may be deferred if an asset has been held long-term. Under deferment of taxation, the corresponding capital gains can be spread over multiple years. Let's now talk about the taxation of capital gains from privately held assets. We distinguish between capital gains from the disposal of corporate shares and other assets. Capital gains from privately held other assets are treated similarly to capital gains from business assets. The taxation of capital gains from shares in a corporation differs between substantial and non-substantial shareholdings, as well as short and long-term. For capital gains from substantial and short-term non-substantial shareholdings, relief is granted via the tax base or the tax rate. Capital gains from long-term substantial shareholdings are generally tax-exempt. However, if capital gains receive a more preferential tax treatment than dividends, there is an incentive to sell the shares instead of receiving dividends. To summarize, many countries allow for preferential tax treatment of capital gains to account for progression and inflation. The preferential treatment can address the tax base, which is the computation of the capital gain, or the tax rate. Both businesses and individuals may benefit from preferential treatment.